Hi Moss 4472 team. In this video, I'm going to take you through chapter 12, our marketing, sales, and collection processes. There are two major types of sales processes, and they depend on who you are selling to. You can either sell your products to an end customer, so business to customer processes, or alternatively, you can sell your products to another business, and these are business to business processes. The main difference between these two is when you are selling directly to customers, chances are you are going to incur a greater marketing expense and have a bigger marketing budget, and perhaps you might have more customers than business to business sales. Usually with business to business sales, you have less customers, but those customers purchase larger quantities from you. So an example of a business to business type of business would be the company I worked for, Vale. We sold our materials to different manufacturers. So for example, because we were selling nickel, one of our customers was stainless steel plants because they needed nickel as input into making stainless steel. We also sold nickel powders, which went to a lot of electronics. So many electronics companies were our consumers. So it was other businesses who then use our end product as a raw material or the start of their manufacturing process. Let's look in more detail on the business to customer sales process. Remember that when you're selling to customers, your sales and cash collection can occur simultaneously. For example, if you're at a grocery store and you pay for your groceries in cash, you are receiving your payment right away. So let's talk about all the various aspects of this process. We have our marketing, which allows us to connect to our customers and more specifically figure out who is our target market, what are their needs, what are their wants. Then we have our sales process, most often some kind of a sales team that takes customer orders. And remember that your sales people might be door-to-door salespeople, they might be virtual salespeople, or they might be cashiers at a store, and their main responsibility is to take the sales order. Then we have our cash collections, and in this way you collect your cash from your customers. Some customers can write you checks, some will pay you cash, some will do credit card payments, and some will do EFTs, electronic fund transfers. So the main deliverable is money or an electronic transfer. And then you also might have some delivery to customers. Let's say you have a storefront online where you have to deliver their orders to the customers. And usually you will give some kind of a receipt. And remember when we talked about vendor processes and our purchasing and payment process, we talked about shipping form. This is the receipt, can also be a shipping form. It depends which business you are, basically. Which side of the fence are you on? Are you the customer? Are you the vendor? What's happening? Let's talk more in depth about marketing. Marketing departments are generally responsible for marketing research, advertising, branding, promotional programs, and search engine optimization. These are the departments who are responsible to figure out who your target market is and how to connect to that market. And you look for venues that will engage your market and allow them to learn more about your product and develop interest. Many organizations purchase customer relationship management software packages or modules for their ERP systems. And these packages manage interactions with existing, past, and potential customers. And more businesses are doing some kind of a reward program in order to connect with customers. They might offer you a promotion if you provide them with your email address. For example, 10% off if you provide us your email, and then you will receive emails from those businesses. And they track your purchases, and sometimes if they notice you haven't bought something in a while, you'll get an email saying, "We miss you, here's an extra 15% to reconnect." These are all customer relationship management strategies in order to create repeat customers and engage customers. More and more companies are using social media as ways of connecting to their customers, and some companies only do their advertising through social media. They no longer use print ads in magazines. There's actually less and less magazines available to advertise in because most things have moved online, or else they'll connect with a company like Google and have ads on YouTube, etc. All ways of connecting with customers. And then control activities for marketing processes include protecting how the business interacts with potential customers. So really keeping your customer information confidential. And there have been a lot of data breaches involving customers and involving businesses. And it's scary how some companies handle these data breaches. They'll just sweep them under the rug. So please be careful and wary of who you provide your personal information to. You'll always see those long forms that you have to click, like, "I acknowledge this," "I consent." A lot of it is in legalese and jargon. So just be careful what you're signing up to is the message, and organizations need to be really cognizant of which data they're collecting about their customers and what kind of security features they have on their system in order to ensure that that data does not get leaked. After marketing, the sales process takes place. So for example, once customers are interested in purchasing the products, the sales process takes place. Offsite, business to consumers send their orders via an app, or alternatively, they might send their order online through a company website. The customer receives a copy of the sales order, a source document with the order details, including the date the order occurred, the customer's name, address, delivery address description, the price of the product, the quantity of the goods, and the total sales price of the order. So when you purchase something on a website, you always receive an email with your purchase information. And if you look closely at that email, all this information will be there. Sometimes your delivery address is different from your payment information address, so you might have two addresses on a form. So please be cognizant of that. Let's discuss the cash collection process. From the point of view of businesses that are B2Cs or business to customer, the occurrence of cash collection is usually at the point of sale. You collect cash when you make the sale, and these payments can be made by a variety of forms: cash, checks. I think those are used less and less, but they're still available. Funny story, my son has a great grandmother, and each holiday she gives him a check, and it is such a nuisance for me because I rarely go to the bank, and this requires me to go to the bank, and she's one of those ladies that has a checkbook that she balances, and she emails me and she said, Joanna, please deposit this check. So it's something that you see less and less, but because you have a generation that is still accustomed to checks are still available. Most of us are more likely to use a mobile payment app than a check. And obviously there's credit cards, control activities for business to customer. Cash collections focus really on in-store transaction because that is where the risk is, because companies are moving away from cash and customers are using more and more kind of electronic fund transfers. Cash collection is becoming less risky simply because it is easier to steal money from a register than to steal a credit card payment, right? Because then you have to go into the bank account, etc. So that area is becoming less risky because we see less cash involved in businesses. When you look at a store, most stores say that maybe 70 to 85% of their sales are on credit or debit. Cash is becoming used less and less frequently. Employees transfer physical cash and goods between business and customers since they create high fraud risk. So this is the fraud risk, is the employees who are moving physical cash and goods. So it is important to have tight cash controls. That's why you hear about cash reconciliations at the end of the day, to make sure that there's no theft or errors. But as I was saying, because cash is used less, this control is still utilized, but the risk has decreased significantly. So when it comes to delivery, two things can happen. Delivery can occur at the point of sale, and this occurs when you are having a sale in person. Alternatively, there might be a process of transferring goods to the customer after the sale and collecting the cash, and this would occur when there's some kind of delivery. So whether it's a food delivery service, an e-commerce shipment, this type of delivery requires an additional source document, and this is the delivery receipt, and it usually contains your order details, the content of delivery, and the customer information that accompanies the product. With some delivery packages, you have the customer signing to indicate that receipt occurred. More and more businesses aren't relying on customer signatures anymore. They just have their delivery people take a picture of the package at the address's front door to have proof or evidence that a delivery took place. When you think about sales, you also think about inventory management. And inventory management is the oversight of inventory from purchase to sales. And inventory management is important to the sales process because sales orders and forecasts determine inventory requirement, which in turn drives purchases of raw materials, supplies, and the production of finished goods. So as I mentioned, think of an organization as a cohesive unit. You have all these different processes occurring, but all those processes are interconnected like a chain, and they rely on each other. So you need knowledge of your sales orders and sales forecast in order to ensure your production plan meets demand, and then use inventory as a buffer for when you don't have a crystal ball and you can't predict reality and what's going to happen. And our sales process also affects how we manage the supply chain. So just to provide you with recall. Supply chain management is the management of the life cycle of a product from procuring raw materials through to customer sales. The sales and collection processes are at the end of the physical life cycle of a product, but the information generated in these processes is used throughout the supply chain. So that's why forecasting budgeting is so important, because it impacts supply chain management and how things are allocated and assigned. You need to know when sales are occurring in order to have your logistic companies delivering them. You need to know where the peak demand is and when the idle time are to even schedule maintenance of trucks, etc. So it's very important that the AIS system or the company's ERP system collects as much data as possible, and analytics is performed to change that data into information, and the information is used to make decisions. Let's look at our overview of the sales and collection process. We acquire raw materials from our suppliers. Those are used in our manufacturing and distribution. From there, we have retail locations that customers can purchase from, or we might have an online app or a website where customers can purchase information as well. But all these processes beforehand impact our sales and collection process. So it is important to know that everything flows together. Now let's dive deeper into business-to-business sales or B2B sales, because they are quite different from business-to-customer sales. Business sales are usually credit sales on account, meaning that the company offers a limit of credit to its customers. This is where we generate our accounts receivables. So instead of an immediate recording of cash on the balance sheet, these credit transactions are recorded as a different asset, as accounts receivables or note receivables, depending on the terms that you provide to your customers. And the reason that you allow customers to buy on account is most business-to-business sales are based on long-term relationships, on contracts. You have fewer customers that make more frequent purchases versus some customers that are business-to-customer sales that might only shop at your storefront once. Here is an example of a business-to-business sales process. In this case, we're using marketing to connect product or service to the customer. So we're trying to attract customers. Once we attract customers, we will negotiate pricing and contracts, payment terms and contract terms. Remember that most business-to-business sales are long-term, so you really need to be cognizant of the contract and ensure that the contract you negotiate is profitable and advantageous to your company. So the document you're creating here is a signed sales contract. After the contract signed, you're going to take your customer orders. So you'll have multiple orders on that contract. If you are shipping to the customer, you're going to provide the goods via some kind of shipping distribution service. If the customers pay on account, then you need to collect cash from customers. If they pay you cash right away, then you don't have to worry. But you are going to have to issue invoices and either collect checks or EFTs. Marketing from a business-to-business perspective is really focused on acquiring customers and getting contracts. If you are selling a finished good to a retailer, you're trying to build relationships with those retailers and to get shelf space. If you are manufacturing a product that's raw material for another business, for example, when I mentioned Vale, we had nickel, which was a raw material used in stainless steel. Our customers were stainless steel companies, and we're looking at finding them, or they were finding us. Whereas with business to customer type of marketing, you're doing advertisement and marketing campaigns. In business to business, you're building relationships. And retail customers are businesses with retail stores where the other company's products are sold, whereas manufacturers are the businesses that would use your product as an input in their process and will classify it as a raw material. Pricing and contracts. So once you have acquired new customers, you will need to negotiate a price and also evaluate the customer's potential, especially in terms of credit worthiness. Once you have evaluated the risk, you can set your sales terms and create a sales contract. The selling price of the products and services are set in the pricing process. This usually is a type of negotiation that occurs with the customer, and pricing goes hand in hand with the marketing processes. So pricing is linked to marketing because it's all about building those relationships. Companies generate interest in their products with marketing, but setting a competitive price that customers are willing to pay is equally essential. So part of marketing for business to business is pricing and creating a competitive price. Let's dive a little bit deeper into evaluating customers. Companies have to check the credit worthiness of new customers before extending a line of credit. Existing customers also need to be reviewed to ensure their credit worthiness remains in good standing. So this should be a control process that businesses do on an annual basis to ensure that the circumstances for customers didn't change. You should look at the age of your receivables and evaluate where your customers stand. Credit criteria are factors used to determine the financial strength of the customers, and credit terms are always dependent on the customer's credit worthiness. Sales contracts. Remember that contracts can be standardized, but they can also change based on the customer and the situation. So if the company's standard terms and conditions for credit sales do not apply to a particular order or customers, then the amended terms should be laid out in an appropriate enforceable contract. This contract needs to be signed and accepted by both parties and approved by management. It is critical to ensure that all non-standard contracts are approved by management, and sometimes it is even prudent to have management review standard contracts to ensure that nothing was missed and the contract is truly advantageous. These agreements should be accessible in the customer's records. I know with our customer credit terms, sales terms, we had all the contracts filed and accessible in our AIS so that if we're doing analysis, we could easily look at the terms, and our contracts usually changed on an annual basis. So along with our budgeting and planning process, there were customer negotiations and we would rank our customers. And remember, profitability isn't the only factor you should consider when you're ranking customers. You should always look at the strategic implications of having that customer or losing that customer. And it is important for legal counsel to approve and review and approve sales contracts that deviate from the standard terms and conditions. And most large corporations have a big legal department. We had a big legal department that looked at contracts and assisted us as need be. Sales orders. So once you negotiate your price, your creditworthiness is approved, a sales contract is established, you need to onboard the customer, make sure that they're entered into your customer table as well as their credit terms and negotiated price. At the time that the sales order is received, no transaction occurs unless there's a requirement for advance payment. Remember, this all pertains to our revenue recognition principles. Upfront payments made before the conditions of the order are fulfilled result in deferred revenue because we haven't completed our part of the contract. So it all goes back to Rev Rec. With our business-to-business customers, they can either pick up the order at the business, whether it's a warehouse, storefront, or manufacturing facility, or they can opt for having the product delivered to them. Either way, the customer would generate a sales order. That order would get inputted in our information system. And if the customer was picking up the order, you would have a pickup request, and the customer would go to the business's location and pick up the order. Alternatively, if the customer wanted the goods shipped to them, then you would have a packing slip, which would prompt the packing of the goods for the customer. That would lead to a shipment and a delivery to the customer. Now that I mentioned these picking requests and packaging slips, let's talk about what these documents really are. The picking request is an instruction to warehouse employees to prepare the correct quantity and product for shipping to the customer or having it available to the customer. Warehouse employees prepare an order for delivery. As part of this process, they use the information in the picking request to create a packaging slip, which is also a source document showing the customer's name, delivery destination, and the contents of the delivery. And we spoke about this when we talked about our purchasing process, how when goods are delivered, we look at the receiving slip versus the packing slip. In this case, we would be the business preparing the packing slip because we are part of the sales now. Now that we've sold the goods, we have to look at billing and collection. So after the products are sold, a company must bill its customers. The billing system generates an electronic sales invoice using data recording from the sales order, picking slip, and packing slip, and they send the invoice to the customer. The sales invoice is sent to the customer with another source document called the remittance advice. Now that we understand the sales and collection process, let's talk about how we can control for fraud and mistakes. The most common financial statement fraud cases involve revenue and receivables, and they're usually initiated by management. And they're initiated by management because management is often under pressure and has bonus incentives to overstate revenue in order to meet the profit targets. Sometimes misstatements can occur due to error, but the best way to negate both errors and fraud is to have effective controls. And one of the most effective controls that you can have is an automated sales process that isn't susceptible to management override. Revenue misstatements. Even with an automated sales process, revenue recognition is a high risk for financial misstatements, and this is whether it is caused by errors or a result of management financial statement fraud. It is very important for you to know your revenue recognition. I think we're covering more than enough information in this course, so I'm not going to demand it from you, but know at which point revenue should be recognized. This will help you in your CFE. Cash collection. Cash collection involves receiving cash from customers, depositing it, and recording the cash receipts. The collection process, known as the cash receipts process, increases the amount of cash line item, the most liquid of current assets on the balance sheet. Please remember that cash management is an essential part of the business, and a lot of businesses fail not because they're not profitable, but because they have poor cash management. So it's really important to look at your cash receipts and your cash disbursements, forecast them, and make sure that you have a positive cash balance. Also, look at your cash collection by customers to make sure that you are not falling into bad debt and have a lot of uncollectible accounts. Part of the cash collection process is receiving payments, and this is the most crucial part for accounting professionals to understand in the collection process. The method of payment collection depends on how the customers purchase the products. Bank deposits. So a lockbox is a post office box that can only be accessed by a company's bank. The bank collects the checks daily, deposits them into the company's bank account, and sends 3 source documents to the company electronically. The remittance advice explaining the payments customers made, a bank remittance report for the day that lists the checks received from the customers, and a deposit slip as proof of the amount deposited into the company's bank account, with the amount of deposit equal to the total of the bank remittance report. And this is a good way to go with these lock boxes because it eliminates the company's employees receiving checks and bringing them to the bank. A lot of fraud occurred with check tempering. Employees would steal checks and cash them out and pretend that the accounts receivables were never paid. For large companies with lots of customers and receivables, this was a prolific form of fraud. So by having customers pay directly into the bank rather than to the company, it really decreases risk of fraud. So here's an ERP system that shows where the marketing, sales, and collection processes are. We have our customer relationship module that looks at customer management and marketing management. And then we have our sales module that looks at receiving orders, receiving payment, point of sale systems, quotations and estimations done by our sales team, and the shipment of product. And this gets put into our accounts receivables if we have credit sales, and our general ledger. So here we have a nice view of all the modules that are affected by these processes. And we always have inventory, as we talked about, because sales decrease inventory. And we have our supply chain management because of the shipping and receiving involved. I hope you found this lecture helpful. If you have any questions, please feel free to email me or talk to me in class. Have a lovely day. Bye, everyone.